Good evening, friends. I hope I'm audible. Was just facing some technical issues, and I think now we are good to start. Awesome. Great to see a lot of you again. Thank you so much for participating on a weekday evening. I'm assuming you're all enjoying your lockdown. Just a couple of sincere requests because I tried doing this last time, but somehow it was an issue. Ensure that your camera is off. Please ensure that your camera is off. Please ensure you're not sharing your screen. We will interact through the chat box. Be absolutely free to ask any question anytime. We are going to discuss the fixed income mathematics part. So there will be some numbers and some calculations coming your way. And this will be real time. This will be, when I say real time, obviously market is closed, but the idea is to see how in the real world the pricing for fixed income securities work and try to connect that with the bond yields and other information. Roughly 1 hour, it might extend because we will have to do some calculations. Excel is what will be the primary focus, and we will also understand certain other things. The focus today will be on pricing. So, whenever you're doing bond pricing, the most important term that we hear about is yield to maturity. Again, I can see from the mix of audience that I have students here, I have investors here, I have, I think, few advisors also. The perspective for each of you will be slightly different. Please customize by asking questions, anything that you want. I will try to answer that. Yield to maturity is one of the most misunderstood and one of the most unnecessarily complicated concepts that we have. So every single bond has a YTM. Every bond has its own YTM. And in the bond market, YTM is the most critical number or figure that anybody thinks about. So whether you are a fund manager, whether you are an advisor, whether you are a bond trader, a research analyst, we focus more on YTM. I can show you real life bond traders. If you randomly ask them what is the 5 year government bond price, they may not necessarily remember the price. But the moment you say what was the yield, then they will definitely remember the yield. Because end of the day, they are thinking about yield only. So YTM is the basis of bond pricing. What a YTM for every bond means is nothing but its expected rate of return for the investor. So whenever you go to buy a bond from the market, be it primary market where auctions are happening, be it secondary market where you are trying to buy the bond from another seller, you're essentially talking about your expected rate of return as YTM. And the word expected is very important. This is not the rate of return that you will eventually end up getting. It is not necessary. I have I have kind of heard a lot of people in the industry saying that YTM means the returns you will get if you hold the bond till maturity. Well, it is almost correct, but not entirely correct. There will be uncertainties along your way. Even if you hold the bond till maturity, there will be certain things that will not go in your way. So that is called as risks. So because there are risks, the expected rate may not be equal to the realized yield. So for every investor, we eventually talk about something called realized yield. Realized means what is the actual rate of return that you have got from the bond, and that you will only know eventually after the maturity. When you're buying the bond, when you're valuing the bond, when you're pricing the bond, you're worrying about expected rate. You're basically saying, what is your expected rate of return from this particular bond? And that expected rate has a lot to do with risk in that bond. So if you think the bond is very risky, you will expect a higher rate of return. You must have heard about the basic maxim in financial markets, right? Higher the expected risk, higher the expected rate of return. Now, for any bond, the YTM has three components that are very vital, and I'm trying to be as practical as we can. So if you're very, very academic, if you're from a very non-fixed income kind of background, if you're very academic, then you may lose some part of it. But as I said in the first session also, very difficult to customize a session for everybody when the participants are kind of varied. So try to be with me. There are three components that we talk about in YTM. First is the overnight rate. Overnight rate is the 1 day rate in the market. When I say market, we talk about money market. So what is the 1 day interest rate that the investor gets from the market? And when I say investor, please don't think about retail investors in this market. Fixed income is not a market where retail goes and directly buys any fixed income securities. We are talking about institutions here. We are talking about mutual funds, insurance companies, retirement funds, banks, foreign portfolio investors. So when they are trying to expect some rate of return on any bond, the first thing they look at is what is the overnight rate in the market, which has a lot to do with RBI. RBI and monetary policy decides the overnight rate to a very large extent. So when we say monetary policy, they are trying to figure out what should be the overnight rate. So overnight rate, the benchmark could be call rate. If you know, there is something called as call rate in the money market. Anybody who has seen the market will know this is the 1 day interest rate. So what is the 1 day interest rate is what we are trying to figure out first. Second is, so this is 1 day, right? Now I am trying to value a bond, let's say, which is 5 years bond. So the maturity of this bond is not 1 day. The maturity of this bond is 5 years, suppose. So the second factor we look for is term spread. A little bit of jargons because that's how the market works. Term spread is a very simple concept. If 1 day rate is, let's say, 4%, how much should you expect for 5 years? So 1 day will lead to 1 week. 1 week rate will be given in the market. Based on 1 week, how much should be 1 month? Based on 1 month, how much should be 1 year? We keep building what is called as term spread. The basic logic is higher the maturity, more will be your expected rate of return because the risk is higher. Lending to someone for a day versus lending to someone for 5 years, you obviously think 5 years is more risky. So you expect some extra rate of return that is called spread. Spread means difference. So how much extra do you want? And the third thing that we consider is credit risk. So there are possibly government bonds that we are talking about or non-government bonds. If it is government bond, then we stop here. We take the overnight interest rate, which if you know currently in the Indian market is at around 1% per annum. Yes, you heard it right. 1% per annum is what we are getting on overnight or even lower. So you add to that a term spread. So a 1 year treasury bill, for example, which is a government bond, will go at something like 1 plus something that you're expecting. And if it is not a government bond, you also factor in default risk. That is called credit spread. And all of these three components are mutually exclusive. So all of this three has its own demand supply, market view, expectations. So a lot of things go into deciding each of these three components. There are times when these two remains more or less same, but the credit spread either increases or decreases. Suddenly, corporate bond is becoming lesser yield as compared to, let's say, 1 week back. If you know, this is exactly what is happening in the real market as we speak. The credit spreads are falling in the last 3-4 trading days. So these are all the things that we consider in a normal scenario. In a slightly Indian market scenario, apart from all these factors, we are also going to consider what is called as illiquidity factor. Indian market is very, very illiquid. So the secondary market in Indian fixed income securities is highly illiquid. So you are also going to consider the fact that a lot of these bonds are illiquid. So even if you buy, later you will not be able to sell it. So I repeat, higher the risk you perceive, higher is the rate of return that you expect. Now, you may expect any rate. Please understand your counterparty has to agree with that, because end of the day, it's a buying selling transaction. So the buyer has a yield in mind for a bond. The seller has to agree with that particular yield, and that is when the trade happens. That is when we say 10-year yield today was at 6.12% per annum. What we are saying is transactions in the 10-year government bond happened at 6.12% as the consensus yield that the buyer also agreed, seller also agreed. And once the yield is decided, we can easily calculate price of that bond. Price is very simple calculation. When I say simple, it's kind of school level mathematics that we have. But before I go into it, this is how the market on a demand supply basis keep on checking what should be the right yield. Anybody who has seen the market will know yields fluctuate. Just look at 10-year yield or 5-year yield or even the 1-year yield. It keeps on fluctuating. Why? Because the RBI keeps on changing interest rates. The short-term rates are also driven by market liquidity conditions. If you know, currently liquidity is very excess. So overnight rates and short-term rates are falling because of that. We consider sentiment. These are all the factors that affects the yield. We consider sentiment. If you know, in the last 1 month, because of the virus threat, because of the uncertainty about so many things, last almost 2 weeks, a lot of corporate bonds got sold, except the last 3 working days. Leave the 3 working days. But before that, a lot of corporate bonds were sold by investors. They were very panicky. So what they did was they sold everything and kept money in an overnight bucket. So market sentiment also plays a big role, and obviously inflationary expectations. This is for long term. So inflationary expectations plays a role for term spread. So how much should you get for 10 years has a lot to do with how much will be the inflation over a period of 10 years. We consider inflation as very important in the world of bond markets. So if you hear fund managers talking, they will say we expect inflation to come down over the next 1 year. So we also expect yields to soften. Yields to soften means they are saying yields may reduce over a period of next 1 year, or yields may go up. So we have all these views which all comes together in a dynamic market, and the YTM is decided for the bond. And I repeat, YTM is the backbone of fixed income markets, not price. Price is just a calculation. We can do it in Excel using a function. I will do it in function also. I will do it in a more elaborate way also, because this session is to try and understand the mathematics that goes into the fixed income markets. Little technical, but then lockdown, yaar, come on. What is the worst case that will happen? We just lost 1 hour, right? That's okay. And don't forget one thing which I have requested. If you think there was something that you learned, please support some cause which is supporting poor people who are not able to get food because they are jobless. Strays, if you see, a lot of strays are not getting food because all the food carts and hotels are closed. So try and help them. We are in a privileged situation. So this is the background of what affects YTM. Once you know the YTM, we can calculate the bond price. Let me show you the live market. Let me show you how the live market works. If you know, it's a 9 to 5 market, 9 a.m. to 5 p.m. The market as we speak has closed. If you really want to know the government bond market in India, go to this website, CCIL India. CCIL is the clearinghouse for the bond markets. On the left hand side, so by the way, on the home page, you are seeing the overnight rate. This is the 1 day call rate. Today's weighted average was 4.29. Overall, across all segments, weighted average was 0.82. This is what a typical mutual fund ends up earning, something close to these two rates, 0.55 and 0.82. This is interbank. This is called interbank rate. So currently at around 4.3. This is what is indirectly influenced by RBI. This is what is RBI's targeted rate. So if you know, currently the RBI policy rate is 4% and 4.4%, right? 4 and 4.4. So this is always going to be between that. So this is like what you're saying is okay, how much will I get for a day? So if I'm a commercial bank, this is what I'm getting for a day. If I'm investing for a 1 year bond, I will probably expect little more than this. If you want to see the live market, left hand side, I hope you can see a website by the way. Sorry, I forgot to check. Can few of you confirm? Can you see a website? CCIL. Awesome. Thank you so much. Thank you. So RBI NDSOM, negotiated dealing system, order matching system. This is what is called the live market. So market has closed now, but if you see it between 9 to 5, you will be able to see a lot of these things moving. You will see these prices are going to fluctuate. On the left hand side, you will realize all these are government securities. This is where the bond market trades, unlike equity, which is on the stock exchange. So do you see this is called last traded price? By the way, the first bond that you see, maturity is 2029. This is the maturity. It has paused, is it? I thought it is still on. What has paused? Sorry. Can you see now? I made a mistake. Sorry, my bad. Yeah, this is the NDS trading screen. My bad. Sorry. So if you see, this is the government bonds. Today, the entire day, if you realize 9 to 5, total of 31,400 crores of bonds got traded. Out of which, if you see the first bond, 0.645, 6.45% is the coupon rate. You would know that bonds have something called coupon. GS means government security. 2029 is the maturity. So this is what is officially called as the 10-year bond. Many of you may be aware in the market, we give a lot of relevance to the 10-year yield. You can see the yield, last traded yield, 6.1382. This is percent per annum. This is called as the GSEC 10-year yield. At this yield, the price closed at 102.22. Face value is 100. So the yield comes first, and this yield fluctuates a lot. If you again keep watching this market, yield fluctuates. If you know, we have crossed 6 on the lower side. This yield few years back was 9% plus. So a fund manager or a trader is getting a lot of money not to calculate the price that anybody can do. They are getting the big money and bonus to predict or forecast what the yield will be over a period of time. That's where the moolah is, as they call it. If I'm a bond trader, if I can predict where this yield will be in 3 months, 1 month, just like in equity short term trading, you can make a lot of money here also in both cash market as well as we have derivatives. Separate session I am hoping to take in the coming days. Derivatives. We have government security derivatives also. Now let's look at pricing. Now let's look at how are these prices going to work. So let's look at the first type, treasury bills. This is the treasury bill segment or the zero coupon bond segment as we call it. Pardon me for the jargon, but I really don't know how else to call a zero coupon bond. It's a zero coupon bond. These don't have any coupon. If you see, there is no coupon rate. These are all short term securities. CMB means cash management bill, a security which has less than 90 days maturity. CMB. T-bills, either 91 days, DTB is days treasury bill. So 91 days treasury bill, 182 days treasury bill, 364 days treasury bill, and maturity date is also given. So this T-bill or cash management bill will mature on these dates. So let's look at just randomly this one. I am unable to highlight as such, but let's try. Can you, yeah, so I think you can see a pointer probably. So let's look at this bond, this particular bond, this one, which is 24 September 2020. Now this bond today, if you realize, got traded, the last traded yield, if you see, was 4.45%. Remember, one day overnight you saw was 4.29 just now. So it is more than that. If you see, most of these bonds are trading at more than that. So 4.45, the yield is the percentage per annum, and this is the corresponding price, last traded price. So at this yield, this is the price. So when yield changes, price will change. I will talk about that in a while. So now let me take you back to Excel. 4.45. I will have to write it somewhere because otherwise it will be gone. So 4.45, 97.9227. Right now, what we will do is, if you're all with me, we will go back to Excel and get this price. I will tell you how this prices come, because this session is to know how does the actual pricing work in the market. So this NDS is the actual market, by the way. This is not something which is a dummy trade or something. This is the actual trade happening between mutual funds and insurance companies, etc. Oh, sorry, I did not check the date. Do you remember what was the maturity date? Sure. 30th September, 29th September, 20. Okay, I'll check. I'm getting too many answers. Sorry, I'll check. So, what was that bond? 24th September. 24th September 2020, right? And the YTM that we are talking about is 4.45%. 4.45%. Very easy. Absolutely easy calculation. Not 4.4, sir. 4.45, है ना? 4.45, and the price was 97.9227. 97.9227. Now, whether it is this bond or any other bond, we only have one thing to understand about the pricing, the concept of present value. Many of you are commerce background participants. I can see that. Present value. You must have done something called time value of money. Present value is nothing but the future value of any cash flow divided by 1 plus the rate of return that you are expecting. This is how you calculate. And if it is more than 1 year, we say to the power n. There is something called as compounding effect that will come. So I hope you have done this formula. Future value is equal to present value times 1 plus r to the power n. This formula, I am absolutely sure you have done it, especially if you're advisors, then you're calculating future value of a portfolio or of a client. If you're an investor, or in general, if you've gone to school, I think this formula was done long back. This is called compounding. This is compounding. In bonds, we already know what is the future value. This is by the way face value which I have written. Face value is the redemption value. This is the future value that I will get. So if you know how this bond is going to work, suppose you buy this bond today, suppose at this price, 97.9227. You buy this bond and you wait till maturity. Then the central government of India will repay to you 100 rupees. Very simple. Nothing in between. You pay something today, you get back 100. So liquid funds invest a lot in these bonds. Ultra short debt funds invest a lot in these bonds. These are called zero coupon bonds. Other examples of these bonds, just for your understanding, has commercial papers, certificate of deposit. All these are zero coupon bonds. What I am discussing is treasury bill, but the pricing works the same way every time. This is always per annum. Every time yield is per annum. So what is the calculation of the price? Price is nothing but discounting. So we say future value divided by 1 plus R, which is the rate of return that you are expecting from this particular bond, but this is per annum, times certain number of days. So let me put it here, because please understand, yield is per annum, but I don't have 1 year before September. I have only lesser number of days divided by 365. I'm just converting a per annum interest into a lesser number of days interest. Obviously, I will calculate this and I will get you the price. So this is how the pricing will work. It looks complicated to many. I don't know why when I do tradings also, but it is very simple. Present value formula is something that is the opposite of compounding. So if you see this formula here, what you're doing is future value is given to you. So you're taking this part here. In less than 1 year bonds, we do not do to the power n. This is called pricing convention. This is not subject to what you think or what I think. Market is very clear. Less than 1 year, we do not do any compounding. So we do what is called a simple interest calculation. So 4.45 is for 365 days. How much for my holding period? I'm going to hold this bond for certain number of days. So then the price will come. Obviously, it is not coming now because the number of days is missing. So how many days am I going to hold the bond for? No, Sanchit, treasury bills is not 360 or 364 only. In India, we get it for 91 days also, 182 also. And please understand, I am buying this from the secondary market. So when this bond was issued, it was a 182 day treasury bill. Please understand, when this bond was issued, it was 182 days. But now you're going closer to maturity every day. So I'm not buying it from the government. I am buying it from the secondary market. Now we have to calculate number of days. I will go as simple as you can imagine. We are on 31st March. If you know, we have something called as T+1 settlement in bond markets in India. So when you buy a bond today, you don't pay today, you pay the next working day. Some of you know equity is T+2, right? Settlement cycle is T+2. Bonds are T+1. Money market is always 365 days, Rishabh. So there is no 360 for money market. 360 comes for bond market. The next example I will take, which is for a long-term bond. Money market is always 365, be it commercial papers, be it treasury bills. So T+1 is when I pay. Now what is T+1 from today? 31st March is today. Now, little bit of practical info. Tomorrow, settlement is closed. If you know, 1st April is bank account closing. So tomorrow, settlement is closed. Not my decision, RBI has decided. Also, day after tomorrow, some of you know, is a bank holiday. I mean, we are on a holiday mode overall, but there is an official bank holiday day after tomorrow. I think it is Ram Navami or something, if I'm not wrong. So technically, 1st April and 2nd April is Shutti for settlement, which means you are actually going to pay for this bond on 3rd April. Interestingly, if you can imagine. It's a very kind of topical thing. It is not always going to be 3 days later. But abhi do chutti hai beech mein kya karenge? So T+1 is T+1 working day. So 3rd April you pay. 3rd April you pay because 2nd is holiday. 1st is closing. So settlement will not happen tomorrow. 3rd April you pay. The moment you pay on 3rd April, you will start getting your interest from that day. So your accrual, again a jargon, accrual starts from that day, from 3rd April till you will get it till what day? Understand, when is the maturity? 24th September. Now when 24th September government gives you the money back, it will give you the interest till 23rd September. It will not give you 24th ka interest because repayment is on 24th. So interest will be till 23rd. So what you have to do is you have to calculate these number of days. So I will go the old fashioned way. I know Excel has functions, but my objective here is not to teach you Excel functions. We are discussing pricing. So April 28 days, May 31, June 30, July 31, August 31, September 23. Only till 23 September, you add all of this, you're talking about 174 days of remaining days till maturity. So the number of days for which you will get this particular interest is for 174 days. Ta-da! Do you see the price coming? This is the price. This is the price. This is what was the price or NDS if you remember. This is the price. This is how you calculate. So exact number of days you have to calculate and just simple discounting. This is the only logic you have to know. Present value is future value divided by 1 plus R. If you know this formula, you can price any bond under the sun. I am not making it up. People unnecessarily complicate fixed income markets. It's easier than equity. Equity is very complicated. It's not easy to value. So this is how you get the price. Now, obviously, higher the yield, if you expect higher rate of return from a bond, please understand your future value is going to be 100 only. Government will not give you anything extra. The only way you earn more is you pay lower. The price falls. Higher the yield, lower the price. You can see the price is falling. Higher the yield, lower the price. Higher the yield, lower the price. Lower the yield, higher the price. If you expect lower yield, the price will go up. So, leave the last 2 or 3 working days. Before that, yields were going up for commercial papers and CDs and other bonds. And because the yields went up, a lot of short-term bonds had price fall. Higher the yield, lower the price. So as the yields went up, they had price loss. We call it mark-to-market loss. So you must have seen if you're observing the market, a lot of these short-term mutual funds gave negative returns over the last few working days. Of course, Friday RBI came and cut the interest rate. Where interest rate is cut, yields go down, prices go up. You must have seen Friday and Monday the NAV is much higher than Thursday. Some of the bond funds have given good return in a day basis because lower the yield, higher the price. You can see the simple calculation. This is T-bill, by the way. T-bill is easy. You know why? Because there is only one cash flow, nothing else, only one cash flow. What is a little extra in terms of calculation is a coupon paying government bond, because coupon paying government bond means what? There are different coupons that you will get. So you will have to use the same formula. I am not going to change the formula. I will do the same discounting, same future value divided by 1 plus R I will do, but I will have to do multiple times because there is no one cash flow. There are multiple cash flows. So we will do that. On what factors does yield depend? I mentioned that earlier. These are the factors on which yield is determined for any bond. We consider overnight rate, we consider term spread, we consider sentiment, we consider expectations about future interest rate cuts or what RBI will do, etc. So we consider a lot of factors. What is the frequency of compounding? Nothing. For money markets, we don't compound. Compounding only happens for long-term bonds. So for less than 1 year, no compounding. Today, if a person is purchasing bond at 97.9227, what is he expecting in terms of yield? Obviously, this yield ना. इसका जो yield आया था कितना था हमारा yield? 4.74 कितना था? I forgot. 4.40. What was the yield? Something. So that was the yield ना. उससे तो calculate किया हमने. So जो yield था उससे price आ रहा है. मतलब they will get that much yield if you hold the bond till maturity. If somebody pays 97.92 means the yield is whatever it came to. I think it was 4.5 or 4.55 or 4.75. I forgot what was the yield. So that yield you will get, whatever was the corresponding yield. Oh, is it 4.45? Correct, 4.45. So that is the yield you will get if you buy at 97.9227. But not everybody is happy at that yield. Somebody will say, you know what, I'll move, I need higher yield. Democracy, capital markets, free market. So anybody who expects higher yield will go in the market and bid for a lower price. So if he gets it, awesome, because I hope you understand it's a demand supply driven thing. Term spread is calculating using linear interpolation. No, it is not. A lot of non-linear stuff works there. Nothing linear in that. Investment in bonds will be done by someone who has compulsion to do. I mean, compulsion matlab pata nahi. Mutual funds have liquid funds. Liquid funds has to invest for up to 90 days. Yeah, that's how their fund is created. Retail doesn't invest in all these bonds. What else? What else? What else? Do I see any other question? Fair enough. Let's proceed because we have audiences probably waiting for more things. Let's look at a coupon paying bond now. As I said, it will be a little more than 1 hour because we are doing calculations. This Excel file is all yours if you want. Just send me a WhatsApp. I'll send you the Excel file. Is the procedure for calculating yield of bond the same as treasury bill? Yeah, we don't calculate yield. Yield comes based on of expectations. We do not calculate yield was the first point I mentioned. We never calculate yield. We calculate price. Yield comes based on expectations of how much rate of return do you want based on the factors I had mentioned earlier. So we don't calculate yield, we expect yield. Based on the expected yield, we calculate the price. So we are trying to understand if you have a expected yield, which is based on multiple dynamic factors, which is what a trader or a fund manager is getting paid for, we will have to understand what is the price. Can we say 10-year yield is a risk-free rate in CAPM model? You can use multiple risk-free rate in CAPM model. The most commonly used is 10-year because equity is what is priced in capital asset pricing model. Why did we compound? We did not compound. We did not do any compounding. I will take you back to Excel and you will realize I did not do any compounding. Why would someone invest in the bond? Jackie, I already replied to you. I said that liquid funds have a mandate to invest for up to 90 days. Commercial banks have to maintain SLR. Insurance companies have to maintain in GSEC. So I don't call it compulsion. I call it how the portfolio is created. For you, 4.4 may look very less, but the fact is 4.4 could be awesome for a lot of banks whose cost of borrowing is 3%. Why can't individuals invest? I mean, individuals can invest. That is not a problem. But why would you invest? I mean, if you get a FD at 5%, why do you want to invest at 4.5% here? But if you do want to invest, you can. You can go to RBI or you can go to the stock exchange and buy the bonds. No problem. You can buy, but highly illiquid. You will not be able to easily buy these bonds. And Komal, I will show you the Excel file in a while because I am now showing the CCIL screen again. Can you see the pricing screen again? Central government security, are you able to see this? Or only I am able to see this? So now what we are trying to do is value a bond which is coupon paying. Now this will be multiple cash flow case. So let's pick a short-term bond. Otherwise, we will only do pricing for a long time. Let's keep a short-term bond. Let's pick a bond which is, let's say, this one. I'll pick this bond. From the top, this is the shorter maturity, 2024, right? So about 4 years from now. We'll pick this bond. We'll pick this 6.18 4th November 2024 bond. 6.18 is the coupon. 4th November 2024 is the maturity. We will pick this bond and 2020 is too close. That will be as good as a treasury bill. Are HNIs allowed to invest? Yes, HNIs can very well invest. Even retail can invest. Please don't think I'm partial towards HNI. Retail can also invest. But the question is, A, retail, do they have the understanding of so many things? B, isn't FD a more convenient option? C, mutual funds give you gilt funds, debt funds. Why not go to them? So, coupon rate 6.18%. Face value for a government bond is always 100. YTM, let's assume is whatever, 6% because I will change it and we will compare the price, or 5.84%. Maturity date is what? Maturity date was 4th November 2024. Settlement date. When will you pay for this bond? So when I buy this bond today, again T plus 1, we already discussed tomorrow and day after is chutti. So 3rd April 2020 is when you will pay for this bond. Frequency of coupon. If you know, government bonds pay coupon 2 times a year, half yearly. They pay coupon 2 times a year. Frequency of coupon. So that is all what we need. Why? Because I will tell you two ways of pricing. One is there is an Excel function called price. Simple Excel function called price. No brainer. You don't need to know too much about what is happening. You can simply put the price. Again, the yield is the first number that has to come. Yield results in price, never the other way around. In the real world, we don't think about price first. We think about if I buy a 10-year bond or a 4-year bond or a 5-year bond today, given so many factors, what should be my expected yield? I'm happy at what yield is what you have to think about. And it is very subjective. Yield that I expect is not what yield that you will expect. Please understand. It's very subjective. Not everybody is expecting the same YTM. That is why the market trades at different prices. So you can see the formula here. It is asking you for information. You can clearly see it there. It is asking for settlement date, maturity date, rate is coupon is the rate, yield, YTM, yield to maturity, redemption as in redemption value. How much will you get back on redemption? 100. Frequency of the coupon, semi-annual. We pay 2 times coupon a year, and that's it. This is the price at a yield of 5.84. Let me take you back for a second to the real market. The bond which we are discussing is this one, 6.18 4th November. The last traded yield, if you can see, is 5.5781. This is the last traded yield today, which means today's last transaction happened at a yield of 5.5781. I hope you can see that. And what was the price at that yield? What was the corresponding price? 102.4. So somebody expected this yield for this bond. Somebody came in the market and said, I want a 2024 bond. I am expecting 5.5781. The seller said, you know what? I am agreeing with you. Let's deal. So they agreed at a price. Price is just a calculation. The first negotiation happens always on yield, 5.5781. So in my Excel file, if you remember, I have already put in all the details which I need. So if I simply change this to 5.5781, you will get the price. You can see the price. This is the price. This was the price on NDS. Now, in the bond markets, something which you should know is we round off everything to intervals of 0.0025. This is something that we do in Indian bond market. This is called tick size. As I said, the idea is to be practical. So tick size. We round off everything to 0.0025. So this price is actually 4002. But we did not see 4002. We saw 40. Why? Because we round it off to the nearest multiple of 0.0025, then 0.005, 0.0075. SA, the prices keep on fluctuating. You can see this is the price. And how did this price come? Very simple. We just did the same calculation that we did in treasury bill. Just to answer one question earlier, see, I did not do any compounding in treasury bill. This is called simple interest. There is no to the power n anywhere. There is no caret sign if you see. Here I wrote it. I just wrote it as a formula. But in treasury bill, we don't use any caret sign. We will do compounding in the case of a coupon paying bond. Well, lockdown, tough session maybe for some of us, but I had mentioned that we will be doing maths. And to be very honest, I mean, I don't know, not very complicated maths, but I think so. Maybe I've done it multiple times. You also 2 or 3 times you see it, you will get used to it. Assume that there is default by government. How will the pricing change? If there is default, the price will fall because some of the cash flows you're expecting to receive, you're not going to get. So risk has gone up, yield will go up, price will fall. What is Jackie asking? Is there strips in India? Yes, there is strips in India. Not equivalent. There is actual strip market in India. Not just equivalent. We have a proper strip market. Assume there is a government. Yes. If there is a default, the prices can fall. Yield will go up. Higher the risk, higher the yield. So if you know, after the European debt crisis, Greece government bond was trading at 35-40% YTM. 40% YTM means investors are saying to the Greece government, I will invest in your bond, but I expect 40% YTM. If you're okay, then I will buy. Otherwise, thank you so much. Now, the same government is at a yield of less than US. Sabka din aata hai. How frequency was taken as 2 is so government pays coupon twice a year. Frequency means how many times will you get coupon. So, ये जो 6.18 है ना, this is 6.18 rupees per annum. And we get 3.09 rupees every 6 months. This is how government pays interest in India, half yearly. How does bond market in Japan work? Yeah, negative interest rate, no problem. Yield can be negative. Price is still calculated same way. Price will go up in that case. Price formula once again, please. So it is the Excel price formula, by the way. I call it the function, right? Excel calls it function. So this is the price function. You have to just put what he's asking for. He's asking for certain information like when are you paying for the bond? When will the bond mature? What is the redemption value or face value? What is the coupon? What is the yield? You have to give this information. And Excel is very smart. Excel is very smart. So it is doing all the calculation that it is nothing but discounting of cash flow. Then why say government bond is risk free? I don't know who told you government bond is risk free, but many governments default. Oh, Indian government bond is risk free. Sorry, my bad. Oh, Indian government bond is totally risk free. We have never defaulted. Be very proud of it. Indian government has never ever defaulted. But you cannot say globally all government bonds are risk free. That is not true. Globally, many governments have defaulted. Brazil, Russia, Spain, Portugal, Italy, Greece, Mexico, Argentina. So you can say government bond is risky. They can also default. Indian government has never defaulted. Long-term repo, we will look at it separately, sir, not the focus of the day. We have limited time for now. So let's look at the pricing now for this. This is where it gets very interesting. I will use the same formula to get to this price. What does 102 indicate? That's the price. That's the price of the bond. The present value of all future cash flow. Why will someone invest with a yield lower than coupon? Coupon is very relevant. You have to consider what you need from your investment perspective. You have to consider current market conditions, current inflation, current liquidity, current overnight rate, current term spread, current credit spread. I mentioned a lot of factors here. You have to just look at all of this on current date. So just always look at current date. Never look at historic. Coupon was decided on a particular date. It is not relevant today. Coupon is not relevant for our cash flows today. Coupon was decided not today. Coupon was decided earlier. So now let's look at when will the coupon be received on this bond. This is where you will have to focus. I understand some of the questions I haven't answered because it's not in context of what I'm discussing. I am trying to get to this price without using Excel function with only one formula, which is the present value formula. So this bond is going to give me half yearly coupon. 4th November 2024 is the maturity. You can be rest assured that this bond was issued also on 4th November some year. Issue date was also 4th November, always. because bond is always issued in either 1 year, 2 year, 3 year, 4 year, 5 year, even numbers. So we know for a fact that next coupon on this bond will be received on 4th of May 2020. May, November will be the cycle for this bond. 4th will remain same. Then 4th of November 2020. So May, November. I'll continue this now. This will go till, if you understand, 4th of November 2024. These are the remaining cash flows of this bond, by the way. These are all the remaining cash flows of this bond, because 4th of November, 4th of May, we will go till maturity, 4th of November 2024. What are the cash flows we are going to get on these dates? I already told you, coupon is 6.18, which is per annum. So every half year, 3.09. So we get 3.09 every 6 months. And on maturity, you get your 100 rupees also. So we are assuming everything will be fine, right? Government bonds don't default. So we will get all these cash flows. By the way, these are future values. This is not present value. This is future value. We have to discount it. We have to calculate the present value of all of this cash flow. Only then we will know what is the price. So in T-bill, we did it once. Here we do it multiple number of times. So to discount, we need number of days. We have to understand how many days are left for the next date. So this is 4th of May. When am I buying this bond? When am I paying for it? I am going to pay for it on 3rd of April. I hope you understand 2 days holiday. So this is when I am going to pay for this bond, 3rd of April. So what we have to do is you have to calculate number of days to the first coupon. How many days are away? When you receive your first coupon, we have to calculate. And when you calculate, this is not a T-bill now. This is a long-term bond. There is something called 30 days a month convention. Very interesting, very weird. A lot of people kind of don't like it, but I can't change it. We assume there are 30 days in every month. This is an assumption we make in government bonds in India. The convention we use is 30 by 360. 30 days in every month, 360 days in a year. That is how the calculations work. 30 days in every month, 360 days in a year. So 30 days is what we will assume in every month. April, May, June. Every month we have 30 days. We don't calculate 31 and 28 and all that depending upon the month. Now, calculate from 3rd of April, if you understand. In April, you will have remaining 28 days. You will receive the interest from 3rd April, 28 days. And May, 3 days. Only 3. Why 3? Because 4th, you are going to get the coupon. Whenever coupon is given, it is given till yesterday, always. So if 4th coupon date is there, you get the coupon till 3rd, which means the first coupon is 31 days away. You can check this. The first coupon is 31 days away. And remember, it's a half yearly cash flow. 6 months, 6 months, 6 months. So how many half year are you away is what we have to calculate. How many half years are you away? 31 days is number of days divided by 180. How many half years are you away? Because every cash flow is half year, coupon is half year, yield also we will take half year. In the world of government bond, we look at semi-annual cash flows. So because the cash flow is semi-annual, we consider everything for half year. This is how it works in the market. This is real world calculation. This is how bonds are valued. So I repeat, 28 days in April, you will get the coupon for, and 3 days of May. So 28 plus 3, 31 days away is your first coupon. 31 days is, if you understand, 31 divided by 180. What is 180? 6 months. 6 into 30. So you are 0.17 half year away. The first cash flow is 0.17 half year away. Second cash flow is this plus 1. Because understand now, from 4th May, you're 6 months away, then 6 months away, then 6 months away, then 6 months away. We are calculating, if you can imagine, the power. We want n. We want to say to the power what? So we will say to the power 0.17, which is what? 0.17 half years. Next cash flow is 1.17 half years away. Next cash flow is 2.17 half years away. This is where real world is very interesting, and this calculations continue. So the final cash flow is, if you understand, 4th November 2024. So if you realize, we are roughly 4.5 years away, roughly. So what is 4.5 years? 9 plus something half years. 4.5 years is 9 point something half years, if you understand. 4.5 full years into 2 is 9.17. So this is half years. Why half years? I repeat, coupon is half yearly. So that is why everything has to be calculated half yearly. And do remember, I am considering 3.09 here. Why 3.09? Because that is the first cash flow. That's it. You will need only this much, and then you can use the formula. What is the formula? Future value divided by 1 plus YTM. You know what was the YTM for this bond we had taken? This much. But इसको divide by 2 करना पड़ेगा आपको. क्यों? Because वो full year का है. 5.5781 is per annum. So we take half yearly. Why half yearly? Because coupon is also half yearly. So 1 plus R. This is the R component to the power time. Half years. Every. So if you see E38 is this 5.5781 divided by 2. So it's a half yearly rate. Because it is half yearly, we take also the compounding for half yearly. Now compounding will come, just to mention specifically to Komal. Because in first example, I didn't compound. Now I'm going to compound. And just one little thing I will do, I will freeze this cell. Because if you know, the yield is going to be same for all the cash flows. This is the present value, by the way, of this cash flow. Present value is always lower. I do this for every cash flow. I do the calculation for every cash flow. Same formula, but only thing is, I hope you understand, the n is changing, to the power n is changing. That's it. You take the total of this. You take the total of this. This is the first number you get. If I am allowed to use the jargon, this is called cum interest price. This is called cum interest price. It includes accrued interest. It includes certain interest that you are not supposed to earn. So if you see the price is not matching, I hope you know we are supposed to get this price eventually. It is not matching. Why it is not matching is obviously because I am not done with one calculation. Cum interest price is called dirty price. Absolutely correct, Manish. You're right. This is called dirty price. The fact is, again, if you think logically, I took 3.09 for this calculation. The fact of the matter is, I am only supposed to get 31 days of interest. And this 3.09, if you know, is for 180 days. It is for the entire 6 months period. So when I buy the bond from my seller, this is a secondary market transaction. I have to pay that person's share of interest to him. This is how bond market works. Again, you must have probably done this in in dividend also. You pay for the other person. So it's like, think about it. Suppose Tata Mutual Fund is the buyer here. Suppose, just an example. And suppose the seller in this example is HDFC Mutual Fund. If you understand, Tata Mutual Fund is buying the bond only now. HDFC was holding the bond over the last so many days. Over the last, if you understand, total 180 days coupon minus 31 days that Tata Mutual Fund is holding the bond for. This is how the two people were holding the bond in the last 180 days. And we are very, gentleman type people in the market. So we will pay 149 days proportionate interest called accrued interest to HDFC. We give it to them. Because understand, 3.09 is for the entire 180 days. You have to split it. You have to share it. You have to share it with HDFC. So I will give to HDFC, to seller. How much will I give? I will give 3.09, which is the full 180 days interest, times 149 divided by 180. If you understand, we are just calculating proportionate interest that the seller has to get. I am entitled only 31 days. So out of 3.09, some part I will get, some part HDFC I will have to pay to them today. So I will pay so much to HDFC. What is left is the clean price. This is called clean price. This is what is the NDS price, by the way. And again, I hope you can reflect on this. It is exactly equal to what the Excel price was, 102.4002. This Excel function is doing all this calculation that I showed in like split seconds. That is why Excel is obviously so important. But my intention was today to show you not just how to use Excel function, but literally understand what's happening behind the scenes, because this paves our way. This kind of helps our way for the future discussions that we can have. For that, it is very important to understand how are the cash flows discounted. This is all called discounting, by the way. These are all present values. I know a lot of maths looks daunting, but to be very honest, it's not that complicated if you know only one single formula, which is present value calculation. So this is the clean price. This is the price that you saw on the NDS. Why is it called dirty? Because we don't consider that price as a cost. So there is a lot of accounting terms be involved in that. No real logic. We just call it dirty price. Clean means clean. There is no adjustment that you need to do to calculate your cost. This is the real cost, by the way, for the buyer. This is what the purchaser will show as the buying price of the bond. And don't forget, we round it off. So NDS showed a price of 102.4002. And you can again understand the same logic. Suppose this yield goes lower over the next few days. Just look at the maths. If the yield goes lower, everything else remaining same, the price is going up, if you see. If the yield goes higher, price will fall. If the yield is exactly equal to coupon, suppose, then the price will be exactly equal to 100. If the yield is equal to coupon, you will get pretty much almost as the same price. This is obviously because of what is called as rounding off. So we say in the world of academic sense that price will be 100. In the real sense, we get a little bit of adjustment factor. This is how bond traders trade. They need to know where will the yield be going forward. So somebody who buys the bond today, you're expecting that the yield is going to go down, price is going to go up. This is something which you will be able to understand if you kind of go through it once more. It's a matter of practice if you really want to do it. People who invest in fixed income without knowing much is kind of not doing justice, I believe. So you kind of at least some point probably want to know about the details of the cash flow. As I said in my session, this session is going to be a little bit of a mathematical thing, obviously. This is how the pricing calculation works. DCMB is days cash management bill. Days cash management bill is DCMB. Menon sir, thank you so much. I am happy that you're in the session. It's obviously going to be a little heavy for some of us. Thank you, Girish. It is going to be heavy if you're learning all of this for the first time, but I think it's kind of important to know how yields and cash flows are affecting the prices, because end of the day, that's literally what happens in the bond market. That is exactly what is happening in the bond market day in, day out. If you want to be in this market for long, it's some time at least once you should kind of go through it. Excel file is all yours. I hope you understand that the idea is to share. This is all yours. This overall video will also be uploaded on YouTube. My intention was to cover a little more, but I will have to keep it for a different session. I'm so sorry. I kind of overestimated myself. I kind of underestimated how much time it is going to take. So my sincere apologies. I'm not able to cover duration at this point, but I will surely cover duration. I will in coming sessions. Lockdown is till 14th. We have 2 weeks, so I am intending to do few more sessions. I will keep you posted on LinkedIn and WhatsApp. These are my contact details. If you need any information, then you can always WhatsApp. Few more questions have come. Why don't we pay HDFC in present value? Again, market convention, Rushabh. It's a very good question, Rushabh, you're asking, but we have an accounting reason for that. In accounting, when we do accrual, the accounting accrual doesn't consider present value. If you know, accounting has no time value of money. Accounting is purely based on nominal value. So HDFC is already recording income for 149 days as per nominal value. It will be unfair to now give them present value. So we don't discount the 149 days interest. You have a very valid point, but there is a reason why in accounting, because we don't use time value, we are not doing. Please do more session like this. Of course, the intention is to do more sessions like this. Some of you obviously have been my students in the past, so it's a revision for you. I understand. Somebody who's very new can be a little tricky, but then just go through it once, maybe revise it if you want, and maybe you'll understand better. The accounts for charity purpose, if you remember, the purpose was to do charity. So either you can give it to Goonj, you can get the information on Google. Goonj is doing a lot of service for poor people. You can also give it to Help India. They are also trying to solve. For stray animals, I have other information. Manan sir, I will share it to you Pakka in WhatsApp. For stray also there is unfortunately no NGO at a India level who is doing something, but there are individual people I know who are doing a lot in other places like Andheri, Dombivli, Powai. So I try to help them in whatever way. I am doing it myself in my surrounding area in Kalyan because strays are not getting a lot of khana at this point. Just to confirm, Neha, yes, Rishabh was asking why are we not discounting 2.5578? Because if you realize, we just took the nominal value. I did not take the present value out of that. So yes, that is what Rishabh was asking Neha. Buying price for Tata Mutual Fund will be this. This will be the cost for Tata in the books. So tomorrow, if you sell at 103 for Tata, this will be the capital gain. The capital gain will be compared with 102 because this is just a revenue account logic. Since Jackie is a CA, I can very much use accounting jargon. This is the revenue account logic. This is the actual cost for Tata Mutual Fund, 102.7. Liquid fund is 29 days average maturity. Average, yes, they try to keep it less than 30, but they may have some bonds which are more than 30 days also. And in mutual fund, the moment you cross 30 days of maturity, there is going to be mark to market. You will have to do mark to market. Abhijit, I will cover swaps and derivatives separately. I am intending to do a session on that also. I will keep you posted on LinkedIn. Can we do a class on selecting equity mutual fund? Yes, Yash, I will try to do that also. WhatsApp me anything that you want. I will very much try to cover whatever I can. My only intention is to try and share whatever little I know. Please cover long-term repo. Rishabh, yes, I'll try to cover that. Sincere request, please WhatsApp me also about these requests on this number because uh, I have a very, very bad memory. I'm getting old. So please WhatsApp me. I would be very happy. Mr. Modi ji, is it Narendra Modi? Wow. Can we split yield in three components as explained? If Narendra Modi is attending my session, I'm very happy. Just kidding. We can't. See, honestly, I really cannot figure out how much is the person saying is the term spread and how much is credit spread. If it's a government bond, it is very easy. You know the overnight, the difference is the term spread. Like government bond has only two components, but corporate bond has three components. A little tricky to ask a buyer, can you give me a breakup of all the three? It doesn't work like that. Fed rate cuts and impact. Akhil's, yes, Akhil, please WhatsApp. Pratibha, for 1st April, even less than 30 days. Not from 1st April, Pratibha. I think it is postponed to 1st May. You can cross verify it once, but I think I read somewhere that because of this lockdown, they're kind of postponing it to 1st May. Then 100% mark to market for liquid. Awesome. I hope you had some learning. I hope you learned few things on your lockdown evening. Thank you so much. Thank you so much for your time. Pleasure interacting with you. Take care, guys. Keep sending me WhatsApp messages for doubt. Zoom I am closing, but WhatsApp I'm here. Okay. Excel file on WhatsApp. Excel file on WhatsApp. Please send WhatsApp. Thank you so much, guys. Take care. Bye bye. Thank you all. Thank you so much. You're all typing. Thank you so much. I really appreciate that. Thank you. Deepak, my WhatsApp number is right on the screen, so I'll just put it here also 98191306337. It's right on the screen if you can see an Excel file. I think I've shared the file, right? Yeah, I think Excel is shared, right? So you can see it. I've highlighted it. This is my Excel, sorry, my WhatsApp number. Thank you. Pleasure. Take care. Bye bye.